Now we're going to talk about global investment performance standards. This year, global investment performance standards, or GIPS, is a new topical area, and it's one that is going to be emphasized even more. So what brought around GIPS? Well, as the investment management industry becomes more globalized, so does the need for standardization in performance reporting. So given an illustration here, it's no longer just a domestic performance reporting issue. We have an investor here. An investor is trying to decide on a money manager, and that money manager could be in Europe, could be in North America, or it could be in Asia. And what the investor would obviously need to do is be able to select who he or she thinks would be the best performer. And in this case, this could vary widely. If an Asian country has little or no performance presentation guidelines and how to, policies on how to calculate and present, the percent return from this money manager could be materially inflated but not comparable with someone from North America or Europe. So there's a need for standardization and in calculating and presenting investment performance. So this investor here is making a very informed and knowledgeable choice. So the GIPS works on trying to make performance complete and fairly presented. And I think as time goes on and the GIPS are accepted, there'll be more of a confidence where firms can play now in different countries where they have been unsuccessful against local firms. So it kind of puts everybody on the same playing field. So the constituents of GIPS basically are the investor and then the firms. All right, and so again, GIPS attempts to get worldwide acceptance of the standard across all countries for calculating and presenting and doing proper disclosures. And another thing it does is foster a sense of self-regulation, where the industry is now AIMR is saying that let's use these standards for performance presentation. They're high standards. We're regulating ourselves, and we're trying to make ourselves really a top-notch industry, so investors are going to feel a greater confidence level. There are 5 main parts to the global investment performance standards, and the first one is input data. And there are certain guidelines that GIPS allows or requires, not unlike some of the performance presentation standards that we've talked about in the standards. But as far as input data, they need to require that all that underlying data is captured and maintained. So you have to have all of the raw data and maintained and the calculations, so you can go back and look at it. And portfolio valuations across the board are based on market values. In some countries, they were based on a cost or a book value, which obviously would be uncomparable to performance actual market value performance. So again, we're trying to standardize how the different countries have used the data accordingly. As we do in performance presentation standards here in the United States, portfolios will be valued quarterly at a minimum. So quarterly performance. And we want everyone to use trade date accounting, obviously with different settlement days being significant in different countries, or sometimes it takes a week to settle or 2 weeks. This type of standardization of accounting could be material in the actual output. And then also accrual accounting for fixed income. Now, this is a work in progress. GIPS is being rolled out, but it's going to take time for everybody in all of these countries to come up into compliance. So they're shooting for accrual accounting for dividends to be available or required by January 2005. All right, so there's going to be a lot of things we're going to see here that are some things we require now, and others we understand that different countries need to come up to speed a little bit, and they need some time to be able to comply with the guidelines that AMER is setting here in GIPS. So those are some of the input data requirements that we're going to be talking about. I think they're fairly common sense, and the calculation methodologies are very similar to the performance presentation standards that we have seen. Calculation, it's always a total return with realized and unrealized gains plus income. So again, total return. Require time weighted, not dollar weighted or anything else. And obviously the purpose is just for cash flows, and we geometrically link the time periods. Geometrically linked. These are basically the required elements for GIPS. There is some recommended elements which I don't think we need to focus on. There's plenty of these required that need to be adhered to. Any market values of fixed income instruments must include accrued income. All right, so that value needs to be in there. The composites will be asset weighted and use the beginning of the period weights. Again, if you have another country using end of the period weights, that could vastly change your asset weighted performance. So use the beginning period weights. And the last one is you have to include all cash equivalents in your total return. All right, so again, this is a methodology of calculation which they want everyone to utilize. So again, is to be able to compare the data. So the next area is composite construction, and this is how composites are put together, and it requires that all actual fee-paying customers. This excludes non-fee-paying customers. These are discretionary accounts, obviously. And they have to be at least in one composite. All right, so if you have a situation where you have a conservative composite, a balanced, a growth, an aggressive growth, an all-stock component, an account needs to be in one of those composites. Now, you can break out your equity performance, say, let's say this conservative, balanced, growth, aggressive growth, all stock, and your equity, and let's say you have a fixed income. You want to cite your performance there. Some of these could be in 2 or 3 composites. So, but they have to be in at least one. And it's based on similar investment objectives. It's typically how they create the composites. And typically, anytime there's a new portfolio, the first full quarter needs to be included in the composites at the conclusion of the first full quarter. So if somebody came in February, it would come in April, May, June would be the first quarter that it would have to be reported on. So they have to be portfolios added timely. We'll just call that